Well, hello everyone. Thank you so much for coming to HAP Financial Group's estate planning presentation. Probably not my favorite subject, but a very necessary one. It's one where you do a little bit of work and it goes a long way. Sadly, over the years, I've seen situations where people got some bad advice, and you know, I'll give you a quick example that just popped in my head. I was dealing with someone who didn't want to go through the trouble of changing all their beneficiaries on all their IRAs and retirement accounts, so they just put it all to the estate and just said, "Oh, my will will explain where I want my money to go to all my family members." What they didn't realize is when you leave retirement account money to an estate, the state is forced to pay all the taxes immediately. Now, for individuals to get to the highest tax bracket for a couple, it's over $500,000. For an estate, it's like 12 grand, and you're taxed at the highest possible rate. So, although it's not terribly complicated, and luckily the reason for that is, the estate tax has been bumped to around $30 million. New Jersey doesn't have an estate tax anymore. So you don't have to do anything crazy, but you do need to make sure you have your 101s in place, you have your normal estate planning documents, and we don't make any rookie mistakes. So tonight, I'm going to go over all the fundamentals when it comes to estate planning, give you a good understanding of some basic terms that you'll hear when it comes to estate planning documents. Naturally, if you have any questions, there's a little raise your hand feature in the Zoom. There's a little chat box. You can put a question there. And of course, everyone here has my email, my phone number. Call me at any time. We can kind of walk through your situation. But today we'll give you a pretty good fundamental idea of what you need to have in place when it comes to your estate planning documents. So with no further ado, let me share my screen. So what is estate planning? Uh, More or less think of it just in a broad terms. Is your legacy. Everything that you're trying to leave behind once you pass, where do you want it to go? What speaks to you? Whether it's financial assets, retirement, businesses, gifting, charities, everything is tied into your estate plan. Now, who needs one? I would recommend everyone has an estate plan. Now, if if you don't have a lot of means and you don't have maybe you're not married, no kids, pretty simple situation. Most of the time, you can Google documents and just get, I would Google New Jersey estate planning documents. Something is way better than nothing to have in place. If you have nothing in place and you have to deal with the state to go through the processes, whoever's going to be responsible for that, it's just a pain in the butt. So I recommend everyone has an estate plan. Now, what I just gave you an example was it's arguably kind of free. You put together something, it could be even a Word document, something to have in place for will. And I'm going to go through a few other your basic documents. And then there's individuals. I'm working on a client right now, and we're going to probably spend $30,000 on estate planning documents and having a bunch of moving parts. But everyone soup to nuts should have some documents in place with regards to their estate plan. And please, if you have kids, you absolutely need to do this immediately. God forbid something happens to you. Guardianship over children, you don't want the courts to decide that. These, although tough decisions, you want to make those decisions as opposed to courts. Well, what is in your estate? Long story short, everything. So, house, real estate, jewelry, artwork, stocks, bonds, really anything that has any value is part of your estate. Now, what's the whole point of estate planning? Well, everyone's is a little bit different. And I'll walk through some of the main examples. So, one, some individuals want control after they pass away. I'm going to give you a quick example. Uh, let's say you have a child who's 19 years old and likes to spend a good buck and doesn't really understand the value of money just yet. Maybe you don't want them to get $1 million outright because they'll spend it. So you can set up an estate plan to space out those payments over long periods of time. So again, control of your estate, control of your assets. Avoiding probate. We're going to go through what probate is and how it works in a few slides. Reduce estate and income taxes. Now, luckily, like I mentioned, uh, I, just trying to look at the people on the call today. You know, for individuals who have less than, I forget the exact dollar amount, but I believe it's around $30 million is the estate tax limit for federal purposes. And that is also being indexed for inflation. So, and New Jersey no longer has an estate tax. It does have an inheritance tax, which we'll go over in a little bit. Um, but luckily, estate tax, for the most part, it's not too common for most individuals. Income tax planning around your state, that's a different story. So a lot of times I was dealing with clients who knows that they're going to leave some assets behind and they're in a low tax bracket and maybe their kids are working and making a couple 100,000 a year. We might be processing Roth conversions, not for their own personal tax situation, but hey, they don't need it. We want it to pass to the next generation inside of a Roth, tax free for all of time, as opposed to them inheriting it and having to pay income tax at a higher rate. Protecting spouses and children, we are not going to go into it today, but if you have disabled children and they're on benefits from New Jersey, benefits from the federal government, then it's a whole different subcategory of estate planning that you have to go a little bit deeper into the weeds. And again, that touches upon the disability planning. Reducing disagreements among heirs. This is happening every day across this nation. That maybe the estate documents were in place, but it kept it kind of general. I'll give you some examples of where things can go wrong. Let's say you have three kids and you want to leave everything equally to the three kids, and two of the kids have moved out of state, and one of the kids is around here and they're helping you out. So it's kind of a pain in the butt with a lot of the banking and the finances. So you just put one of the kids and make a joint account at the bank account. There's 100 grand in the account. But when you die, if that was a joint account, that goes to the uh, one, let's say, daughter who was helping you out, who was locally there. Now they might argue that, hey, I was the one helping mom and dad out. I deserve the money. Well, that's a fair point, and also a fair point if mom and dad's will said equally to the three kids, and you know, no one planned on that happening, but disagreements come up all the time. So we're going to go through all the main documents when it comes to an estate plan. I also recommend an additional one, a simple letter. You get the formal documents from attorneys, and they're great and they serve their purpose. But there's a whole bunch of stuff, a little bit more personal, a little bit more emotional, a little bit more small things that you might not include in your estate planning documents. Oh, grandma's chest that's 200 years old. Sue always loved it, so I want Sue to have it. That might not end up in your will, kind of breaking that down that granular, but a little letter that gives a little bit more color to your wishes is probably not a bad idea. When an individual dies without an estate plan, aka without a will, they're down. They pass away in called intestacy. Sorry. More or less, you're leaving it up to state laws to determine what happens with your money. And it's a long, drawn out state process that's not fun for anyone. Now, all of this is kind of straightforward. So, for example, if a husband passed away, and wife with two children, it gets split up according to the rules. These are not negotiable. It is what it is. You died without a will, so we've just determined that the state is going to determine what happens with your assets. Most time, even if that's how you wanted to split it anyway, a will is going to be a much faster process to accomplish anything. So again, everyone I would recommend having a will. What are the basic estate planning documents? So we just discussed your last will and testament that says whatever is in my estate, this is what I want to have happen to it. Two, somewhat common in New Jersey, although our probate process is not terrible. Other states, the notorious one is Florida. where their probate process is extremely painful, everyone has a revocable trust in Florida or a revocable living trust. So, what that more or less is while you're alive, it acts like your asset, tax wise, flows onto you. You can put money in, take money out. But once you pass away, now it acts like a full-fledged irrevocable trust, and everyone has to full follow the rules of the trust. So I would say somewhat optional in New Jersey. Other states a little bit different, but those are the two main types of documents that distribute your assets. The other main ones are financial power of attorney. I recommend everyone puts one in place. There's what's called springing power of attorney and durable power of attorney. Springing, hence the name, it springs into action once you become disabled. Now, that's subject to interpretation. Maybe one doctor says, yes, you are no longer capable of handling your finances. Maybe someone else says you are. It's a little dicey. So what I typically recommend is a durable power of attorney. I would recommend you hold on to it. The person you trust, tell them where it is and everything. But I probably wouldn't give it to them until I was, I don't know, somewhat close, we'll say. But I would create it and have it in place. A lot of time, husband has it on the wife, wife has it on the husband, type of thing. Medical power of attorney is more or less the same thing, but for medical purposes. So if you were to go to a hospital will have a rule who they can disclose information to. So a medical power of attorney allows for the medical field to speak to the person you've given the power of attorney to. And living will more or less describes, hey, if I become in a vegetated state, I want you to either keep it going. Let's see if I can pull through, or pull the plug. So those are your typical four. So definitely everyone I want to have four. That fifth, the revocable trust, if it speaks to you, great. Um, and like I said, the sixth would be that, again, I just recommend everyone do it. Just a letter that, you can go in any direction you want. But a lot of the smaller things that might not end up in a will, you just type up in a letter and give a little explanation, who you want to get what of the smaller stuff. And like I mentioned before, appointing a guardian of your children, you do not want the government do it. So again, not always easy. Um, you know, this is one where I would ask the person um, whether they'd be willing to accept it. So this is one where I would disclose it. Not, I would never disclose like, hey, you're getting this in my will, or you're this beneficiary, because you could change those at any time. But one where you're getting the humongous responsibility of watching over a child. Yeah, you want to make sure that person is willing to accept that responsibility. Okay. So how does your will work, and what assets are included in your will? So oddly enough, it's not as much assets as you think goes by your will. Really goes through things that are in your name and in your name only, that don't have beneficiaries associated with them. When you have a will, you have to go through the probate process. So you have your will, typically uh, you have your will and you have a death certificate. So your executor, which are the person you're saying who's going to be in charge of your estate, which you're going to define in your will, would take the will, take your death certificate to the county, say this person's passed away, I'm the executor. The county will issue a letter of testamentary, so say a document that says you are the executor, and then you can start going to all the institutions that there was assets or accounts open, and acting on the estate's behalf. That is more or less the probate process. Now, again, there is a lot of assets that are not part of your estate, not going to be settled by your will. So I was mentioning before, mom put one of the daughters on the bank account. Now it's a joint account. So if it's joint with rights of survivorship, that goes right to the other person. It doesn't make a difference what the will says. Joint property that's rights of survivorship just goes to the other person. Life insurance, if you have beneficiaries, does not go by your will, goes by the beneficiaries. Same with retirement accounts. I gave you the example earlier where someone put their estate. So you can, but horrendous income tax obligations that the estate are going to pay if you leave your retirement accounts to your estate. POD or payment on death or transfer on death accounts, these are taxable accounts where you're decided to add a beneficiary, which is fine. Again, avoids probate and does not go by what your will says. And any properties in trust. We were talking about revocable trust before. So let's say a normal situation, someone who's done well for themselves, let's say 2 million bucks in retirement accounts have beneficiaries. The house is owned joint. Bank accounts are all owned joint. And let's say dad passes away, maybe it's his car is the only thing is in his name. That might be the only asset that has to go through probate. Sometimes that's a good or bad thing. The estate sometimes needs liquidity. So if everything is done outside of it, you might want to do something to have at least some funds that the estate can settle up any last expenses or any debts that are owed. Um, Again, that's more of a one-on-one conversation to put some structure around things. But again, a lot of times the majority of people's assets are not going to be handled by the will. This is where not one of my clients, but I had someone who had a retirement account that they forgot to update it, and it was left to an ex-spouse. Nothing overrides it. Wills don't override nothing. It's not material. Whoever the beneficiary was, it was. It's not subject to interpretation. Revocable trust. So just briefly go over it. While you're alive, you can create a trust that the assets acts like it's your money. You put money in, take money out, do as you please. The tax obligation flows through onto you. At some point you passed away. Now it's no longer revocable. Now it's irrevocable. You typically have a trustee that manages the trust assets and has to follow the rules spaced out in the trust. Now, trusts are flexible. So, for the most part, they're a pretty good blank slate on whatever you want to have happen. I want to allow 5% distributions a year. And if they get married, then a chunk, and buy a house, then they get a chunk. At these ages, they can get a chunk. You can kind of create whatever you want. Um, Obviously, these things cost money. Uh, you know, from my experience working with different attorneys, just your basic estate planning documents for a higher end attorney, 3 to 5 thousand in today's dollars. You can definitely get good basic documents, 1,000 to 2,000 bucks. That they're no thrills. They're boilerplate, which is fine, which is more than fine for most situations. Um, and then if you're in your 20s and 30s and just want to put something in place, you can kind of Google New Jersey documents. That's something. Having something in place where you signed in front of a notary is better than nothing. And of course, trust planning, that's a whole separate cost, and can go in any direction, however complicated you want it to be. So just to walk through some of the terms when it comes to a trust. So you have just let me walk through an example. The grantor, this is the person putting the money into the trust. You have the trust property. Let's say I'm putting $1 million of cash into the trust. There goes the trust property. And then I've created a trust agreement, spells out what happens. The trustee follows, interprets the rules of the trust to pay out to the beneficiaries of the trust. We were mentioning before revocable trust and irrevocable trust. You can set up both while you're alive. Like I said, revocable acts like it's yours and really no difference while you're alive. Irrevocable is different. Irrevocable is its own entity. You have to set up a separate tax ID. Depending on, you could set it up both ways where the tax obligation of the irrevocable trust can flow through back onto the grantor, or you could have where the trust pays the taxes. Where a trust pays taxes is similar to an estate where you quickly get up to high tax brackets. Um, Irrevocable trusts are no joke. There has to be a real reason why we're protecting this money or we're moving it. That's a very one-on-one, in-depth conversation, but I just want to give you kind of a high level. It's very rare that we're setting up irrevocable trust. You do it for elder care purposes. You would do it if you have very large estates, but in maybe some disability situations, but it's very unique situations that while you're alive, you're setting up irrevocable trusts. Although irrevocable life insurance trusts are sometimes used. Again, case by case, I can kind of give you some guidance on what makes the most sense based on your situation. Living trust versus testamentary trust. Living trust you set up and funded while you're alive. Testamentary trusts are funded upon death. So a lot of times people in their will says, all my money I want to fund the ABC trust, and then upon you passing, the money goes and gets set up during in that process. Financial power of attorney, we discussed this earlier. This is, hey, mom and dad can't really make financial decisions or having a little trouble paying the bills. This is a person you're putting in charge of your finances. Now, just know once they have that power of attorney and they've shown it to all the different institutions, they can sign as if they're you. Um, that gives them total control over what's going to happen with the money. That's a decision you do not take lightly. Now, something else to keep in mind is, okay, great, we have a power of attorney. What people don't realize is, let's say you have an account at Fidelity. Well, Fidelity might also have their own form that needs to be signed. So, and you don't know that, but let's say you put all your documents in place, you got your power of attorney, and now you no longer are capable of making decisions and signing on behalf of yourself. And then you find out, oh, Fidelity needs you to sign a form, but you're no longer capable of signing a form. So it's worthwhile to just check with the different institutions if they have their own forms on top of the power of attorney form. Medical power of attorney, living will. Again, living will. I'm in a vegetated state. These are my wishes to either be kept going or pull the plug. Two, medical power of attorney. This is for the people, the medical staff, to be able to speak to you or speak to your loved ones or whoever you're designating as the power of attorney. Another term for that might be healthcare proxy. You might see that term too. So now we're doing different strategies and techniques when it comes to preparing for an estate plan. You know, a lot of my clients have been found to be in a very fortunate situation where they're not going to go through all of their assets. So, maybe a couple lives their life and leaves $2 million behind. Well, great, and the two kids are wonderful, and they're going to be not happy, but they both get $1 million each, and great. Well, one of the things I always try and do is when we're doing the financial plan and say, all right, for you to not outlive your money, we can spend, and I'm going to make up a number, 150 grand. Let's say your budget is comes in at 130. Well, then you have an extra 20 grand. Well, instead of just leaving it in the big pile that gets divvied up upon you passing, why don't you give 10 grand to each kid now? So you can gift up to 19,000 to any individual you want, as many individuals as you want, without filing a gift tax return. So there's no tax obligation for either party, and there's no tax recording of it either, as long as the gift's under 19,000. Now that 19,000 gets adjusted for inflation, so it tweaks up every year, or at least every other year. Um, and it's not even the end of the world if you gift more than 19,000. You just have to file a gift tax return. Now, that limit might be up to $14 million you can gift. So, not the end of the world. But what the government does is any gifts more than 19,000, they just keep track of it, and so there's a limit that you can't pass on without paying some estate tax. But we're talking about estates more than 15 million plus type of scenarios. Now, one of the things to keep in mind is when you gift something to someone, you're also gifting the cost basis. So that is not a big deal if you're gifting cash because the cost basis for a dollar is a dollar. But where people get themselves in trouble is they start gifting the home. So, I'm nervous. I'm going to go into a nursing home. I want to get the house out of my name and I'm going to gift it to my son. And I bought the home 40 years ago for 50 grand. And now it's worth $1 million. When you gift that home, you gifted your cost basis. So now if goes to sell it in the future, his basis is 50 grand. So he has a $950,000 gain that he's going to pay taxes on. Brutal. If that was in the, let's say, father's estate, that would get a step up of basis. And when they sold it after he passes at $1 million, now the basis is $1 million, and now there's no tax obligation. So when you're gifting assets with low basis, you need to factor that into the equation. I'm not saying you never do it, but you have to weigh the pros and cons of things. This is why, to switch gears briefly, one of the greatest assets to kind of gift to charities is positions that have low basis. So if you were fortunate enough to buy a stock for $10 and now it's worth $50, well, you don't have to sell it. So you get to avoid paying the taxes on it. You gift it to the charity. They don't pay taxes on it. Um, so we got to avoid the taxes and they got the $50 worth of stock. So low basis stuff is good for charities. Um, we're going to touch upon a different angle with the IRAs later, but charities are certainly a part of a lot of people's estate planning, especially if the alternative to the charity is Uncle Sam, then people open up a little bit more. So we'll go through some scenarios. Yes, and roughly 14 million is the lifetime gift tax limit. So a couple of things that break the rules of the 19,000 limit is one, 529s. So, and just remember, it's 19,000. So, for example, if you have one child and there's two parents, both parents can give 19,000 each to that child in any year and not file a gift tax return. Now, some things that break that rule are what's called 529 plans. These are college plans. So you can gift up to 5 years up front in any 1 year. So now that money is rather incredible. 529s are owned by the individual, let's say the parent in this situation. So it's still part of your asset. If you die, it's actually held outside of your estate. It kind of breaks all the rules. And it's growing tax free. So 529s are really wonderful, wonderful vehicles. Two, you can go above the 19,000 if you're cutting a check directly to an institution for, let's say, college. Or three, any medical care, again, cut directly to the medical provider. Life insurance, typically estate tax free. Two, provides instant liquidity for an estate. I always, depending on how much liquid assets you have, it might be crucial. So let's say, this is where people can get into a tough spot. You know, let's say you own a business and it's a very successful business worth 5 million bucks, but all of your net worth tied into that business, and you pass away suddenly. When your heirs have to keep the doors open and we don't have any liquidity, I've never run this business before. So life insurance is crucial to hopefully bridge the gap between, maybe selling that business in a year or two. So fantastic vehicle to kind of help with the estate planning process. Um, it used to be a very big planning tool, not so much anymore. Irrevocable life insurance trusts. When it used to be the estate amount was $1 million. So people were quickly getting over the estate limit and having to pay estate taxes. Well, life insurance, if it's held outside of your estate, such as in an irrevocable life insurance trust, would not be considered part of your estate. Again, not too much of a big deal in today's environment with the federal limit for a couple at 30 million bucks in New Jersey not having an estate tax. Well, I just gave you the answer to one of these. Again, New Jersey, probably about 10 years ago, got rid of the estate tax. It used to be 675,000, brutal. Now it's gone. But it does have an inheritance tax. So let's go through an example. Say Bob passes away with $1 million. Like I mentioned, the estate does not owe any taxes on that $1 million, but depending on who the beneficiaries are, they might have to pay taxes. So let's say it's $1 million and it's left to the son. Note that is a type A beneficiary, in which case, just think up and down. If you're leaving a mom and dad, kids, grandkids, no one's going to pay any inheritance tax. When you go sideways, let's say Bob left it to his brother, depending on the size of the estate, he's going to have to pay somewhere between 11 and 16% tax on what he inherits. And if you continue to go further, cousins and friends, then you're tipping toeing into the 16, 17, I think it might be high as 18% tax that they're going to have to pay. So no estate tax, but certain beneficiaries will have an inheritance tax. Again, if you're going out, up and down, you're fine. You're leaving money to your kids, no estate tax, no inheritance tax, no federal tax. If you're under 30 million, nothing to be too concerned about. Now, this is a big topic. Um, Elder care planning. So, typically, what I recommend for my clients is around 75 years old, you sit down and have an elder care conversation. Now, if you have long term care insurance, which I would say 9 times out of 10, people do not have long term care. A lot of times, I do not recommend long term care. It's one of those policies, it's expensive. There's a decent probability you don't need it. The pools of money they're providing are becoming smaller and smaller. It's a painful policy to have. It might be crucial. Some situations, I do find it necessary, but there's a lot of situations where I don't. Now, if you don't have long term care insurance, you can work with a elder care attorney to try and protect some of your assets. These are situations where you are using irrevocable trusts to try and move securities into them. To if you do go into an assisted living facility costing 150,000 a year and you're there for 4 or 5 years, hopefully protecting some of your assets for your loved ones. Um, no two situations are the same. Um, Typically, you can't move retirement money into these types of trusts. Typically, these trusts need to be set up for 5 years to be eligible for Medicaid. This is where I typically recommend people around 75 say, what, if anything, should we do about elder care planning around long term care events? Like I mentioned, everyone's situation is a little bit unique. Some people I say you should self insure. Some people's assets I say you just got to hope for the best. A lot of people in the middle, maybe we are protecting some money, but we can't protect all of it. It's a unique situation that, again, I'm just giving you the age. That's when we ought to have these conversations and just kind of weigh the pros and cons and weigh kind of the probability. We don't know what the future looks like. So we're just trying to figure out what is the best option based on this probability and the resources we have. Now, some things to consider is, there's different rules for different states. Some states still have an estate tax. Some have an inheritance tax. Um, it could be a situation where maybe you own a piece of real estate in Florida. Well, that has to go by different rules. You have property here, property there. So if you have assets in other states, you need to have a secondary conversation about, all right, what's the game plan around this reality, considering Ohio has this estate tax rule. Charitable wishes. So, I'm going to give you a quick example. Let's say you got 2 kids and you want to give to St. Jude's. Let's see, a third, a third, a third. It's wonderful. Well, not all assets are created equal in this situation. If we have an IRA and you give it to your 2 kids, well, they're going to maybe pay 25, 30% income tax. It's not a very good one to inherit. A Roth is tax free. So instead of, in this situation, leaving the IRA, a third, a third, a third, 2 kids in St. Jude, and the Roth, 2 kids in St. Jude, I would do St. Jude, let's say 100% for the IRA, because they're not going to pay an income tax. And the Roth, and maybe money in a house and some money in bank accounts, those are great for the kids to inherit. So it might not be exactly across the board the same for everything, especially when charity's in the mix. Um, there's different trusts you can utilize for charity planning that are pretty good. Again, these are, if you're depending on your charitable wishes and depending on the size of your estate, there's a whole bunch of different trusts that can set up. If you're in the 5 to 20 million range. There's different things that we didn't go over tonight that might be worthwhile for you to hear. And again, large estates, similar to the charity thing I just mentioned. If your estates are over $30 million, there's some unbelievable trusts. Those things as slats, family limited partnerships, different ways of moving assets to make them technically on paper worth less to get yourself under the estate tax limits. It's just rather incredible when you sit down with an estate attorney and they bring out their chest of different little trusts they get to play with, and it's very worthwhile because, like I mentioned before, if your estate's over $30 million, call it 40 cents on the dollar is going to go in taxes. um, Again, so when I'm saying large estates, I'm talking about 30 million plus in today's day and age. Well, that, based on everything we went over, that's a good solid foundation of the 101s when it comes to estate planning. uh, what I recommend everyone does is probably at least once every 5 years, you just brush off the estate planning documents, see if they're still worthwhile. If you're 65 years old and you still got your um, estate planning documents when your kid was born, okay, probably time for a new one. I would argue, this is just my own personal belief. I'm sure an attorney would say, get a fresh set of documents every 3 years, but you have that estate planning will and documents typically right before your kids get born or right around that time. Probably your net worth's including a lot. Maybe in your late 50s, you're doing some new estate planning documents. That would probably bridge the gap till, like I mentioned, around 75. You might have some elder care planning documents that enter the mix. Maybe over the course of your life, you're having 3 or 4 different documents that are all good for 10 to 20 years, depending on your situation. But every once in a while, review them. Of course, if disability is in the picture, elder care, then, you know, then is as much as needed. And you don't want to mess around with rules and government benefits and programs. These are things where you have to work with specialized attorneys just to make sure everything's kind of done okay. Um, in saying that, if anyone has any questions, you're more than welcome to type in the chat or hit the raise your hand feature in the Zoom. You guys are too kind that I get to go home and eat dinner. Well, for as always, thank you so much for joining me tonight. If anyone has any follow up questions, shoot me an email, give me a call. But I hope everyone got some value out of today. And again, thank you so much for participating tonight.